Understanding Loan Syndication, a comprehensive guide. Loan syndication is a critical concept in the banking and finance industry. It involves a collaboration among multiple lenders to fund a single loan for a borrower, thereby sharing the risk and the capital involved. This article delves deeply into loan syndication, elucidating its mechanics, key roles, implications for borrowers, advantages, and drawbacks. What is loan syndication? Loan syndication occurs when two or more financial institutions come together to fund a single loan. It is particularly beneficial when the required loan amount exceeds the lending capacity of a single bank or falls outside the individual lender's risk profile. Each lender contributes a portion of the total loan, and their respective liabilities are limited to the amounts they contribute. This arrangement minimizes exposure to risk for each lender involved while allowing the borrower to obtain the necessary capital in a more manageable way. Key takeaways. Collaborative lending: multiple lenders join forces to fund one loan for a borrower. Risk sharing: each bank in a syndicate shares the overall risk and is only liable for its contribution. Syndicate agent: usually, there's a lead bank, syndicate agent, that organizes the terms, documentation, and provides oversight. Association support: organizations like the Loan Syndications and Trading Association, LSTA, play a critical role in facilitating syndication processes. The mechanics of loan syndication. Loan syndication primarily operates in the realm of corporate financing. Companies often require significant financial resources for activities such as mergers, acquisitions, or major capital projects. In cases where the required funds exceed what one bank can lend, loan syndication becomes a practical solution. Loan structure. 1. Single loan agreement: all lenders enter into one loan agreement, which outlines the terms and conditions. 2. Limited liability: each lender's risk is directly proportional to their investment in the loan. Thus, liability is limited to their respective share. 3. Uniform terms: while collateral assignments might differ among lenders, most terms, apart from collateral requirements, are generally unified to avoid complications. Role of the syndicate agent. A lead institution, known as the syndicate agent, coordinates the entire syndication process. Its responsibilities include organizing terms, setting the terms of the loan and defining repayment schedules. Conducting due diligence, performing extensive checks to assess the creditworthiness of the borrower and ensure all aspects of the loan are covered. Loan administration, managing the disbursement of funds and overseeing ongoing compliance and repayment processes. Parties involved in loan syndication. Loan syndication typically involves three primary parties. 1. The borrower, the entity requiring the loan, often large corporations looking for substantial financing. 2. The lead bank, syndicate agent responsible for coordinating the loan, documenting agreements, and ensuring compliance. 3. Participating lenders, other banks or financial institutions that provide capital to fulfill the total loan amount. Example of loan syndication. Consider Company ABC, which seeks a loan of $1 billion to purchase an abandoned airport for redevelopment. Given the size of the loan, J.P. Morgan, the initial lender, creates a syndicate. J.P. Morgan contributes $300 million. Bank of America lends $200 million. Credit Suisse contributes $100 million. Citi provides $250 million. Wells Fargo contributes $150 million. In this scenario, J.P. Morgan acts as the syndicate agent, handling all operational responsibilities related to the loan, ensuring that Company ABC receives the full $1 billion while distributing payments appropriately among the various banks. Effects of loan syndication on borrowers. Although loan syndication offers the advantage of securing necessary capital, it may also come with implications for borrowers. Extended approval process. Since multiple lenders are involved, borrowers might experience longer wait times for loan approval. Higher fees. the complexity of coordinating multiple parties can result in increased fees, including service charges and administrative costs. Advantages of loan syndication. Financial institutions benefit from loan syndications in several ways. Risk distribution. By spreading risk across multiple lenders, no single institution carries the burden of potential default. Enhanced lending capacity. Banks can participate in larger deals they might not have serviced individually, tapping into lucrative loan opportunities. Greater borrower access. Borrowers gain access to larger amounts of capital, essential for significant financial endeavors. Drawbacks of the loan syndication process. Despite its advantages, loan syndication does present certain challenges. Complex coordination. Managing various stakeholders can complicate the loan process, leading to potential communication issues. Prolonged timing. The syndication process can be lengthy, which may hinder a borrower's immediate access to the necessary funds. Increased costs. The expenses associated with organizing the syndicate and managing compliance may translate into higher overall loan costs. Conclusion. Loan syndication is a vital financing mechanism that plays an essential role in global corporate finance. By pooling resources and sharing risks, lenders can cater to sizable loans that would be challenging for individual institutions to provide. While there are nuances and potential disadvantages for borrowers, the approach ultimately facilitates larger capital projects, contributing to business growth and economic expansion. For those looking to explore more about loan syndication, organizations like the Loan Syndications and Trading Association, LSTA, offer substantial resources, insights, and research regarding trends and best practices in the corporate loan market.